good morning from our global headquarters in New York. I'm Manus Krenner. You're welcome to Bloomberg Brief. Let's set your agenda. Fresh record highs. Big tech pushes stocks to yet another all-time high for the 30th punch-out this year. Investors gear up for the retail sales and a marathon of Fed speak after the Philly Fed's Harker floats one and done from the Fed this year. Boeing CEO heads to Capitol Hill for a grilling from senators on the near-catastrophic accident on 737 MAX. A very good morning to you. We are bullish on these markets, the most bullish according to the Bank of America survey since November 2021. We are just punching them out. 30 record highs, and it was the Magnificent Seven. Again, a confluence of record highs there. The NASDAQ, look at that, splendid. 20,227 this morning. That is breaking 20,000 for the first time, and there's no sign of an abatement in that. In the Bank of America survey, the most crowded trade is tech. 69% exposure to tech. That is for the 15th month in a row. So that is about the concentration risk within this market. TSMC also up this morning. Citigroup raises the price target by 12%, talking about stronger earnings for them. TSMC at the bottom of your screen up 1.6%. Again, it is about the growth in the AI and the data centers there. The big tail risk from the survey is falling, and that is about higher inflation. Bank of America survey talks about the tail risk of higher inflation coming from 41% preoccupation down to mid-30s. But when it comes to the bond markets, Harker, again, joining Kashkari in that narrative, one and done. Jumbo corporate issuances. We're going home for Juneteenth in a couple of hours. 19 big issues came through. A little bit of a backup in yields, yesterday up by 5 basis points. BMO took their profits at 425. Barclays say, you want to sell at these levels. I give you the Aussie dollar because of the narrative from the RBA, which I go back to what Stephen Major has continuously said, which is the Tet Peloton. What happens in Australia is prescient, is very prescient for the rest of the global central banks. The central bank in Australia is proving resilient, moves to very high, talking about inflation, and they will be vigilant. That invoked a little bit of a bid to the Aussie dollar. So that's the state of play on markets. We've got this sort of huge swathe of enthusiasm for the equity markets, but it is about the Fed officials leaving their rate, their benchmark rate unchanged last week. We've got that. That's at a 2-decade high. But they trimmed their outlook for how much they expect to see in 2024. I mentioned the Philly Fed President Patrick Harker in the headlines. He spoke yesterday on what he expects going forward.
I had expected bumps in the road, but the Q1 2024 bump threatened to become a hill to climb. Yet, while the lack of progress toward the inflation target was concerning, inflation did not reignite. And while I remain very attentive to inflation risk, the latest inflation data have been quite promising that progress on disinflation has resumed.
Well, meanwhile, Goldman Sachs is sticking with their original quote, writing this. Ultimately, the key driver of labor demand is economic activity, and the GDP growth has slowed meaningfully. We feel good about our forecast of 2 cuts in September and December. So, again, joining a chorus of a whole host of splits in this market between 1 rate cut, no rate cut from Apollo, 2 from Goldman Sachs. Ven Ram is with me this morning. Ven, good to have you alongside me this morning. Here we go. There's some big trigger points in these equity markets. 20,000 coming through on the NASDAQ, the S&P, the 30th record in a row. But again, I go back to the narrative from Bank of America's survey, which is the concentration risk is becoming ever more furious. 69% exposure in tech for the 15th month in a row.
Absolutely, Manus. I mean, this is kind of going beyond worrisome levels. Okay, I mean, everyone understands the enthusiasm towards AI and its potential to boost productivity gains. But if you look at NASDAQ as a bunch of, long duration stocks, discount their cash flows that are going to come accrue in the future, bring them back to present value, and you use an earnings model to value them, what you see is that the fair value is somewhere around 13,000. So even with the AI-related enthusiasm, you could say, let's push up growth here by a couple of percentage points, and say you use a higher than average longer-term earnings forecast, earnings growth, and even then you would arrive at 15,000 thereabouts. So if you're nudging 20,000, that says something about how much valuations have run up. And this can't, it's hard to say when this movie will end, but when it ends, whenever it ends, it's not going to end well.
When this movie ends, man, I don't know. I mean, it's certainly, you know, it's got a pretty strong underbelly in terms of the hegemony of the United States of America. Again, I go back to some of the narrative. You had this race to upgrade from Goldman's, from Evercore, from Citi. That was the narrative yesterday. But then I look at the long-short positioning from the hedge funds, and you've got to hand it to the hedge funds in terms of their positioning. This is Goldman Sachs data as well. Hedge funds, their long-short leverage, cutting their leverage by the most since 2022. Now, you can argue that, look, the market has had such an amazing run-up. You're not that surprised that the hedges are cutting their leverage. We're going into the summer. There's a huge amount of tail risk now beginning to wag, isn't there? The French election just being one magnificent example of an unassumed tail risk. That deleveraging, Ven, how do you read that?
Well, I mean, it's cautious positioning, as you said, going into the summer, and the markets have been glossing over political risk, and that's come to the fore now. So it's not surprising that they're doing that, because, you know, at these extremely elevated levels, we have reached a point of asymmetricity in returns, because increasingly it looks like a correction is in the offing, is what the doctor has ordered. So, I mean, it's hard to see who's going to bid up stocks at these feverish levels. So it's not a big surprise what the hedge funds are doing. And I do expect a correction in stocks in good time to come. But, you know, the market's manners, as you know, they can be insane for longer than you can be solvent. So how long this insanity continues is hard to tell.
What a wonderful phrasing this morning, insanity and the movie. I've only got one more Titanic left in me in terms of these stocks, Ven, that is for sure. Ven Ram, setting the stage on these magnificent breakthroughs in some of the markets, over 20,000 on the NASDAQ and 30 records in a row for the S&P 500. Some breaking news coming through for you. This is from the European side. The ZEW in Germany, the current conditions index actually worsens to 73.8. The estimate was for negative 65. But the ZEW investor expectations rises to 47.5. Now, that had been penciled in to come back to 50. It hasn't quite made it there, but the expectations, the ZEW investor expectations rise to 51.3. So that's the German data for you. We'll see how that does. The euro, as you can see, that is much more about dollar strength than it is about euro weakness. Euro weakness, of course, is being driven predominantly by the uncertainty around France. So it's a toxic combination for the euro. Let's talk about Citi. We've got Jane Fraser. She will be on stage today. It's Investor Day at Citi. What is the ace up her sleeve? The bank's money-moving business, the pipework of Citi. You're right, it's not a glamorous business. It's been called the diamond in a rough by Mike Mayo. He's over at Wells Fargo. Here to talk to us about the story and what Jane Fraser can deliver is Jenny Serene. Jenny, good to see you this morning. You are UK and Middle East finance coverage. So here we are, the pipes. The global pipes that move our wages, that move our FX transfers around. There's nothing glamorous about it, but Citi does it very well.
I think, that's exactly right. It might not be the most glamorous of businesses in terms of, what they're actually doing there. But from a Citigroup perspective, it's actually their most profitable business. And so, yes, that's why we have Jane Fraser kind of taking the stage today and really showing off what this business can do. It's definitely one of their lesser known businesses. So when you think of Citigroup, you really tend to think of the trading businesses or the investment banking businesses, or maybe you're carrying one of their credit cards in your wallet. But no, this is kind of the behind the scenes money mover that actually ends up being their most profitable business kind of quarter in and quarter out that investors have really come to appreciate about Citigroup in the past couple of years.
I mean, Jane Fraser made it very clear. She was at a conference a little bit earlier on. Earlier on in the year in March, there's nowhere to hide for anyone when it comes to accountability. Her target was to cut 20,000 jobs. She is a CEO very much in a hurry to deliver at pace. But then you look at what Mike Mayo's saying is that, she's got a lot to prove. And indeed, she could be either Banker of the Year next year or indeed fired by 2026. So it really is a crucial time for delivery for Fraser, isn't it?
Yeah, I think that's exactly right. So this is a bank that their returns have long lagged their rivals like JP Morgan or Bank of America. And investors are getting pretty fed up. If you look at how their share price has traded over recent years, they're still trading far below book value, which is something that, Jane has talked publicly about being extremely disappointed with and wanting to turn around. And so she's aware that there's pretty deep-seated issues that these investors have. And so when you look at her today kind of showing off this business that really no one else on Wall Street has, you see her really trying to play to Citigroup's strengths here. And so when, trading can sometimes be on its back foot, investment banking has yet to materialize, credit cards are so beholden to like what unemployment looks like or how consumers can keep up with their bills. This is a business that sort of just keeps chugging along and providing that regular revenue that investors just really crave. And so I think that's why you really see her leaning in here and really trying to put the focus on this Treasury Trade Solutions business, this security services businesses. These are just two things that kind of really together really provide that stability that investors are wanting.
Yeah, but this is where really the globality of Citi in terms of its capacity around the world begins to shine, and it puts it really sort of head to head, I think, with HSBC, but perhaps even a little bit more global than that. Jenny, thank you very much. Jenny Serrain, keeping us abreast. We'll check, of course, what's happening with Citi through the day, and we'll hear from the CFO, Mark Mason. He joins the team at 2 p.m. in New York, so a pretty important day for the whole team over at Citi. U.S. lawmakers passed a TikTok ban following a series of briefings that remain classified. Now the app's Chinese owner is seizing on that secrecy in its high-stakes bid to overturn the new law. Joining me now is Bill Ferries. Bill, good to have you with me. So TikTok's strategy here, I mean, it's a bit of a high-wire act. They're actually going to push against closed-door briefings. This would be monumental if they make headway. But real pressure. Why such pressure this week for them?
Right. This saga with TikTok is really hitting a peak this week, and it's set to continue in the months ahead. This week, you'll remember President Biden signed that law requiring ByteDance to sell TikTok within 270 days. He signed that in April. Just over a week later, ByteDance sued and said that this was basically an unconstitutional law. It was an infringement on Americans' First Amendment rights. TikTok has to present its case this week to the court. June 20th, Thursday, is the deadline, and they're expected to rely heavily on criticism of this closed-door classified briefing. They say U.S. officials need to present some kind of a public case, public evidence for why they think TikTok and ByteDance are national security threats. Their strategy here seems to be to try to get the government to declassify some of the material they gave in this closed-door briefing, and it remains to be seen whether the U.S. government is really going to be willing to take that step.
Well, this, of course, will come down to how one interprets the First Amendment, the right to free speech, etc. And we're already hearing from some of the Democrats saying, Richard Blumenthal, they're just a platform. They're not expressing anything. Their users are. So this is going to be the debate. This is the Connecticut Democrat. So what do you think the overall reaction is going to be in the U.S. political world?
Well, I think, there are very few things that unite Democrats and Republicans at this point, particularly in an election year. This TikTok bill was one of them. It passed through the Republican-controlled House. It went through the Democratic-controlled Senate and was signed by President Biden. It's going to drag out for quite a while. We do expect this case to possibly go eventually to the Supreme Court. It's hard to see the law which required the sale by January 19th of next year. It's hard to see that deadline getting met if these legal cases keep piling up. But this week it will be interesting to actually see this argument made to the court. I believe it's the Fifth Circuit, and whether the administration, whether the U.S. government comes out and releases any of the information.
Okay, Bill, let's see how it goes. Bill Ferries there on the very latest on TikTok. Other stories trailing on your Bloomberg terminal. This is what we've got for you this morning. The Reserve Bank of Australia discussed the case to hike rates earlier today before deciding to stick with the current rate, which remains at a 12-year high. Now, the central bank raised its alarm on the stickiness of inflation and pledged vigilance. Apple is shutting down its Pay Later program after only 1 year, retreating from the efforts to offer more financial services in-house. The tech giant was attempting to compete with a firm by letting customers make purchases on an installment plan. Coming up on the show, Stephanie Guild from Robinhood. She is the head of investment strategy. Joins me around the desk a little bit later on this hour. Good morning from New York. This is Bloomberg. It is Bloomberg Brief. I'm Manus Cranny in New York. Welcome to the show. My next guest is Stephanie Guild. She's the head of investment strategy over at Robinhood. We're dealing with some pretty big round numbers, Stephanie, this morning. We've got the NASDAQ above 20,000. We've got 30 records in a row in the S&P 500 and a bullish sentiment, according to Bank of America, that we haven't seen since November 2021. It's like this rallying call. Are you as euphoric?
I am to a certain extent, because I do think we're in a technology super cycle when it comes to things like AI, wearable devices, even in the healthcare space through biotech. But there are a lot of probably things that have put us at risk of this kind of in the short term, sort of not going so well. And I think that goes from like the political agenda of different countries around the world, and also what happens with interest rates and whether we actually go to a recession or not.
Let's just split some of it apart, because the tail risk from France, I think, was very, very unassumed and underpriced. Yet what it did in my mind, and there's a wonderful word which has been used again and again, the hegemony of US assets. So that virulence of political tail risk in France emboldened the hegemony of US assets.
Yeah, I mean, probably. There's a certain amount of, let's just focus on things that are going to do well. Mm-hmm. And I think that always happens when there's uncertainty. They're like, if it's difficult to understand where you're going to find growth, then you're going to go where there is I don't want to use the word guaranteed, but no. There is growth that is very likely, and that's going to be in places like the tech space.
But you have, I think, a healthy skepticism, a healthy caution. You say I would be skeptical about earnings growth expectations of 11% in the S&P 500, especially all coming from the third and the fourth quarters. But then, of course, the concentration is in the higher end. So is that a little bit of healthy skepticism? Because I look back to Evercore yesterday, and Evercore's big bullish call at 6,000 was around AI, was around the earnings per share, driven around that. So that's concentration risk again. Why the healthy skepticism?
I think because you've got 38% of the S&P 500 in the top 10 names, and then everything else below that hasn't been doing as well. And so you can get to 11% if you assume that kind of dominance by the top 10 continues. I think because that's where you're getting most of the earnings growth. If you take away the bottom 490 names, you actually have negative earnings growth for the last 5 quarters. So I think there's a view that that will just continue. But I'm not sure, with interest rates potentially not being cut this year and the job market looking like it's starting to weaken, if it gets pretty weak, then you're going to end up heading to a place where stocks probably need to correct.
I mean, that breadth trade, there's been virtually no sign of a solid correction or a real opportunity to buy the dip. I look at what you're saying is the Fed won't cut much, if at all. I'm listening to Harker and Kashkari, one and done. What does that say to you about the next cycle? I think it's almost immaterial whether it's one and done or two and done this year. What does it say about the cycle?
That's just this year, though. I think about like one and done or two and done. We're talking about 2024. What about 2025? They actually expect more.
That's what I'm saying. I think it's immaterial whether it's one and done or two and done. It's not going to shift the equity dial. But what does in 2025?
I think that you end up getting a slowdown in the economy, and I think there still remains to be seen whether we'll have a soft landing or a harder landing, and that's the part that I'm most focused on. But I do want to go back to something you said before, where you said that there has been no breath, and that's the one part I kind of disagree with, in that I think there's been a lot of opportunity to buy the dip on a name-by-name basis, not necessarily in the stock market broadly.
Yeah, we certainly saw that in Apple, and then it managed to turn it around. Absolutely, the nuance is key, maybe on the index level, but then I suppose passive fund and indexes are what seem to dominate You've got to be an active stock picker to take your opportunity.
So.
Thank you so much. Good to see you this morning. A healthy dose of skepticism in terms of the concentration risk in the market. Stephanie Guild, Robinhood, Context Matters on Bloomberg. Good morning. It's Bloomberg Brief. I'm Manus Crenny in New York. Time for a look at the front pages. This is what we've got making headlines around the world. First up on the New York Times, writing that Israel pauses daytime offensive in parts of Gaza, raising hopes of more aid. The new policy addresses concerns that the combat made aid delivery too dangerous. And it comes after increasingly isolated Prime Minister Netanyahu dissolves his war cabinet. Up next, Reserve Bank of Australia, we mentioned this at the top of the show, raising the alarm on inflation. The central bank keeping rates at 4.35%, but it did warn for the first time that the recent big spending federal and state budgets may have added fuel to the inflationary fire. The Aussie dollar was bid. We had those narratives from the RBA talking about inflation proving resilient versus being high, and that they will be vigilant. So that is the state of play on the front pages. We'll run you through the momentum in these markets. We're counting down to the retail sales, industrial production. How's that going to play out in terms of the close down? It's a beautiful day in New York. Good morning. From our global headquarters in New York, I'm Manus Crenny. Let's set your agenda. 30 record highs in U.S. stocks and counting. Big tech pushes stocks to yet another all-time high. Investors gear up for retail sales and a marathon of Fed speak as the Philly Fed's Harker floats one and done for rate cuts this year. Boeing CEO heads to Capitol Hill for a grilling from senators on the near-catastrophic accident on 737 MAX. A very good morning. Welcome to the show. This is what we've got for you in terms of the equity markets. We're in the green on the S&P 500, 55.46. You're looking at 30 records in a row. My last guest from Robinhood Markets suggested that there were opportunities to buy the individual dips, maybe not at the index level. Bank of America, the most bullish we've been since November 2021. Some of the individual stocks that are on the move for you. By the way, the NASDAQ careering ahead above 20,000. That is, again, another mega record in the NASDAQ. What you have got, however, is, of course, TSMC. We have a nice bump for them. We've got Citigroup raising the price target by 12%. TSMC up 1.73% this morning. Huge concentration in tech. No shock there. It is the most concentrated trade, according to Bank of America. 69% of investors are concentrated there for the 15th month in a row. In terms of the rest of the markets, you've had that headline from Harker joining Kashkari in the one and done camp for the bond market. A little bit of a backup in yields yesterday. We're up 1 basis point this morning. We saw quite a significant 19 jumbo corporate issuances coming through yesterday. So there's a little bit of hedging went through on the books. BMO took their profits. They ran all the way down to 425. They took profit on their bond yields as it dropped to that level. And Barclays are sellers of bonds at these levels. Aussie dollar flat. It was a little bit better bid as the RBA considered hikes, and they talked about vigilance in terms of the inflation narrative. So the traders are gearing up for the retail sales number. That's out at 8:30 a.m. Eastern time, as well as the central bank decisions from the Bank of England, the Bank of Japan, both announcing this week. Enda Curran is with me. So we've got a little bit of a frisky break after Juneteenth tomorrow, and good to see you this morning. When you look at this market, when you look at where we are with retail sales, we've had a number of indications from the stocks that there's a bifurcation in retail. So set me up for the data today.
Well, the retail sales today are supposed to be reasonably upbeat, showing consumers bounced back in the month of May, Manus, after a bit of a lull in April. Now, there are a few reasons for that. There was a holiday in May. There's been a lot of store discounting. People are looking at discounting by the big auto dealers as well. The inflation data showed price cutting in certain areas like electronics, for example. So all told, that's expected to show that the retail sales came in on a positive side for the month. However, under the bonnet, as you mentioned, a lot of analysts are still talking about increasing credit card debt, the fact that consumers have run down their pandemic-era savings. Of course, no real relief on the interest rate front in sight, at least not yet. So even though the May retail sales are expected to be somewhat okay, broadly speaking, the economy continues to slow down. We are seeing that in the jobs market, and it's expected to be continue to be a theme for consumer spending going forward as well.
So we've got Kashkari and Harker. It's interesting, 2 in a row, for the one and done narrative. Which camp are you in? And are you in the Mohammed Al-Arian camp, which is that the Fed is retrospective, retroactive, and the reaction function is wrong because they're reacting to the wrong data, and that the disinflation narrative will continue and improve, and in actual fact, you will see a material slowdown. It's there on the horizon. They're perhaps missing the obvious.
Well, I think for what is clear is they are being very careful, man. So if you listen to the press conference last week by Chairman Powell and indeed the other commentary, they do not want to make a mistake on calling an end to the so-called inflation cycle. Remember back in December, they made that pivot. Of course, they had to reverse gear a few months ago when inflation proved stickier than they expected. We've had one good month of inflation. I would expect the Fed would like to see at least 2 or 3 more months to say, OK, the disinflation trend is pretty much intact. Then they will have a window to ease if they want to. Now, of course, you're going to be getting into complications around the election later this year. People have different views on whether or not that matters, but it's certainly another variable. But I think, above all, the Fed, they keep talking about confidence, and they need to be careful. I think they just don't want to make a mistake and be burned twice. Having pivoted once and gotten it wrong, they won't want to do that again.
Now, and I've got to say, you've written a cracking piece. We spent endless months talking about de-dollarization and flight from the dollar. There's been no sign of that at all in the capital flows. And this is again, it's the one word I would say that has become top of the agenda this week: hegemony. The destination of the US, that outstanding destination in terms of capital and in terms of, let's say, risk aversion. But you've put together the evidence in terms of sweeping aside that de-dollarization story.
Yeah, so absolutely, Mana. So the US has sucked in around 1/3 of global capital flows since the pandemic, and these are numbers that the IMF ran, and that money is pouring into here through portfolio flows. It's pouring into here, of course, into the FDI investment due to government investment incentives, and it's all about the high rates story and all about the industrial policy story that the US is currently running. And it does run against a theme. I mean, on paper, the narrative is de-dollarization, countries in the so-called global south looking for alternatives, a lot of geopolitical tensions, and the US is in the middle of all of that. Yet despite it, money has been pouring into the US. Now, the question, I guess, becomes when might that reverse? When might it turn around? The US itself has political risk. There could be a change of administration after the election later this year, and, of course, policy could look quite different. And that's, of course, without mentioning where interest rates go and how that impacts the yield story here. And don't forget, on the other side of things, if the China story reverses, that would impact. They have the 3rd plenum coming up in July. If that resets the economic narrative in China, that might make investors look the other way too. But right here, right now, the IMF took a look at these numbers. We pulled it together. It shows you that the US has very much been sucking in global capital from around the world, and indeed at the cost of the emerging market world.
Yeah, well, of course, now I think a lot of people are talking about the carry trade, the potential for the carry trade being unwound, looking at these tail risks they're going to mount. You've had the French elections. There will be more to come. The question is, do you have a fiscal risk shock here in the United States of America at the end of the year into 2025? Enda, thank you very much. Setting the agenda there, Enda Curran from Washington. A little bit of breaking news for you. At Golden Goose, we interviewed the CEO on the day they announced their IPO. Today we have the price, $9.75 per share. That is according to the terms that we've seen. So, of course, these are the sneakers, anything from a couple of $100 to $2,350. I can tell you that at that price, at $9.75, the range that had been floated was $9.50 through to $10.50 per share. This is going to be Italy's biggest IPO since Lottomatica. That was last year. Now, they had hoped to raise 558 million euros, $600 million. But this is definitely at the lower end of that pricing term sheet that we had looked at in terms of the range. So we'll keep an eye on that. Danny's not here. I can tell you she has a pair of golden goose sneakers. I'm nearly there. I'm about to pull the trigger. Let's talk about Capitol Hill, because today the Boeing CEO Dave Calhoun heads to Capitol Hill. It'll be this afternoon, the grilling from the Senate hearing on the safety and the culture for the aircraft maker. Let's bring in Sid Phillip. He tracks the Boeing story and global airlines. Sid, we haven't heard that much from Calhoun. Where do you think this Senate hearing is going to focus? Is it going to be on culture, or is it going to be on the 90-day plan? Where do you think the lean will be in terms of the questioning?
Morning, Manus. So yeah, the lean on questioning is, we expect it to be wide-ranging, ranging from sort of questions about whistleblowers have brought up, as well as sort of quality and sort of the constant sort of push against Boeing, that Boeing focused on profitability and building as many airplanes as they could at the cost of quality. So we do expect it to be quite sort of testy, with the CEO getting lots of scrutiny about various comments that he's made in the past, as well as what Boeing has done in terms of trying to get its production back on track, as well as sort of how they've got the 737 MAX to where it is today. So we do expect it to be quite sort of punchy, and let's hope to see what they come up with.
Yeah, well, I mean, you just take your mind back to some of those hearings with the bite downs and the various senators involved in those hearings. They did, of course, Boeing did put out a statement before today. They said, our culture is far from perfect, but we are taking action and making progress. We understand the gravity, and we are committed to moving forward. And part of that moving forward is going to be about the next CEO. It's got to be somebody that's there for the long haul, for the long term, and they're going to have an awful lot of work to do. Do you think Calhoun's legacy, where does it stand relative to what needs to be done going forward?
Yeah, so Dave Calhoun said that he's stepping down later this year, and so he's got to safeguard his legacy in terms of showing that Boeing is actually making the changes that everyone, from sort of lawmakers to customers to passengers, have all sort of asked Boeing to do. So Calhoun's going to sort of show contrition. He's going to talk about how Boeing is making sort of fixes to get it right, to ensure to make their quality better, and in terms of sort of getting, sort of moving on from past mistakes. At the same time, I mean, there's going to be some sort of questions about Calhoun, whether he did too little and whether it's too little too late.
Yeah.
And so I think that's really the question of where Calhoun's legacy really goes from here.
Well, I think they're going to get, I think probably one of the concentrating points today is going to be, you know, how do you treat your whistleblowers? What has happened around that program, the safeguards around that. Just briefly, Sid, where are we on the search for the new CEO? I can't imagine that there's a vast pool of people who are qualified to take on the role of CEO of Boeing. But how is that search going?
Yeah, so from what we understand, the chairman, Steve Mollenkopf, is leading the search for the next chairman, for the next CEO. And we understand that it is sort of gathering pace, and they are sort of ramping up the search for a new CEO, and they're looking for someone with experience in terms of running a public company, as well as sort of the ability to take on the challenges that Boeing faces, as well as sort of not having the baggage of previous management. So I think it is a sort of wide-ranging search, and we understand it's got sort of gathering pace and momentum, and we will sort of be looking out to see if there are any sort of signs of who might be the next CEO of Boeing.
Well, Sid, if anybody's going to break that story first, it'll be you, so no pressure. Sid Phillip, let's see what happens today on Capitol Hill with Boeing. Coming up, Citi is putting one of the least glamorous businesses front and centre in the revamp. More on Jane Fraser's pitch to investors on Bloomberg. Good morning. It is Bloomberg Brief. I'm Manus Cranny in New York. Well, the Fed's Patrick Harker may think it's appropriate for only one cut this year. Goldman, though, they're sticking with the original call. Jan Hatzius writes this. Ultimately, the key driver of labour demand is economic activity, and GDP growth has slowed meaningfully. We feel good about our forecast of 2 cuts in September and December. We have our macro strategist, Simon White. He joins me now. Simon, it's interesting. That's Goldman's in 2. Harker Kashkari, 1 and done. I opened the Bank of America survey. Let me just read this to you. 8%, just 8% of the Bank of America surveys say no Fed cuts in the next 12 months, but 8 out of 10. This is the interesting one. 8 out of 10 investors expect 2 to 3 more cuts, with the first one on September the 18th. So again, the market is saying something very, very different from the Fed.
Yeah, well, I think the Fed kind of threw the cat amongst the pigeons back in December when they did this kind of very unexpected pivot. You know, the market was already priced in 4 or 5 cuts, and you know, the Fed came out and they were, you know, more dovish. So they already had the cuts priced in. There was no real kind of reason why they needed to turn up the dovish dial, but yet they did. I think they were premature in believing that inflation would come back to where they want it to come back to. Of course, they were kind of wrong-footed by that in the first few months of this year. And now we're in a situation where, you know, I think from the economic perspective, yeah, okay, the job market is showing some signs of slowing. It's really, you know, the jury is out yet on what inflation's doing. My own view is that I think inflation is probably kind of the disinflation side of things is kind of done for now. I think the market was too premature to look at the previous print and kind of thinking that that's the story over. But the Fed is kind of giving the impression it's going to look for a window to cut rates, you know, almost the narrowest of windows. It will look to cut rates. So I think that's why we're beginning to get that sort of confusion. I think from looking at the economic perspective, you could argue that the Fed shouldn't be cutting. But we also know that they kind of boxed themselves in back in December, and they will try to squeeze a cut in if they can.
Look, it's also interesting when you talk about that smallest of windows. The biggest tail risk was higher inflation in the survey, and that falls from 41% to 32%. Again, emboldening the case that this, and a number of guests have sort of really reaffirmed this, disinflation is real, it will continue, and it will continue to such an extent that it will give the Fed the opportunity to cut. What I'm curious to know is, we know the concentration risk is high. Long Magnificent Seven, 69%, the most crowded trade since long U.S. tech in October 2020. Now, as Van Ram, one of your colleagues, sort of said, look, this is a movie that might not end well. But for breadth to occur, you're going to need those couple of rate cuts to come through. Is that when breadth really comes into play?
Possibly. I mean, look, the momentum is driving the market right now. You know, if you look at the stocks, obviously NVIDIA, but you look at other stocks like Broadcom and Eli Lilly, everybody's in the same stocks, right? Because the momentum factor is driving returns right now.
Yeah.
And of course, when you have such concentration risk, there's always that risk, of course, that the market then, you know, overstretches itself and you get everyone coming out of the same stocks at the same time. Mm-hmm. Will the cuts make a big difference? You know, I think at some point they could, but even without the cuts, you know, I feel that the market's becoming so tilted in one direction. You know, every hedge fund is in the same strategy. Everybody's chasing the same stocks. You can't, if you're not in these stocks, you're really behind the market. So, you know, I think the cuts at the margin make a big difference, but really, it really comes down to the fact that we have this one of the most concentrated markets in terms of from a strategy perspective than we've seen for some time.
Yeah, and yet you look at that flow data from Goldman Sachs, you're actually talking about hedge funds cutting their long-short leverage by the most since March 2022. I don't know whether that's smart money or just fast money. We'll see. Simon, thank you very much. Simon White from Bloomberg Live team. So it's Investor Day for Citi and Jane Fraser. What's the ace up her sleeve? It is the bank's money-moving business. It's not a glamorous business, and it's been called the diamond in the rough. Mike Mayo has this to say from Wells Fargo. Jenny Serrain joins me. She is our UK and Middle East finance coverage. Jenny, so this is Jane Fraser in a hurry to prove that size delivers scale globally in banking payments.
Yes, no, I think that's exactly right. And so you have her really taking the stage today to talk about a business that really no other bank is able to match them on in terms of just the breadth that Citigroup brings to this area. You know, they have operations in over 100 countries. And so when you're a Coca-Cola or an Amazon or an Airbnb or whatever it may be, and you're looking to kind of take payments or move money around in all these different places, Citigroup is oftentimes your first port of call. And so they really while they have the same trading operations as a lot of these Wall Street banks or the same investment banking offerings as a lot of these Wall Street banks, this is kind of an area where they're able to differentiate. And I think that's why you see Jane really trying to drill down and kind of show off the thing that makes Citi unique. Especially in a year, where the Wall Street businesses like trading and investment banking are maybe a little bit softer than what investors would have hoped for.
But I think her line that came through in March was a very clear warning to anybody in the revamp, which is that there is nowhere to hide for anyone when it comes to accountability. How do you think the market is assessing her revamp? I was just looking at some of the calls. You got 16 buys, 10 holds. We've got a price target of 67.85 on it. But she is a CEO in a hurry to deliver. Has the market rewarded her pace?
I think so. She took control of a bank that has always lacked all of its rivals. And I think she tried to be really decisive when she first came in and make some pretty tough calls. Citigroup, it used to be known for having a branch on every corner, all over the world. And so she's been pretty decisive in cutting a lot of those types of businesses overseas. She's been really revamping their wealth operations, the security services and Treasury and Trade Solutions businesses that we were just talking about. She's been pouring billions of dollars of investment into that. These are all moves that investors like, but there's still very little to show for it. So they still are far behind where JP Morgan and Bank of America are in terms of returns. Their stock is evident of that. And so I think, she's got a little bit of patience in terms of she was always starting from a position that was far behind where her rivals were. But I think investors are impatient. They want to see this bank turn itself around, and they want to see some improvement here.
Absolutely. Well, the stock is up 50-odd%, just over 50% from its sort of lowish kind of point at the end of last year. So that is some kind of indication of belief. But as you say, it is about benchmarking to peers on various metrics. Jenny, thank you very much. Jenny Serrain. Coming up later, we will have an exclusive interview with the Citi CFO, Mark Mason. That joins the Bloomberg team at 2 p.m. New York time. It is Bloomberg Brief. I'm Menace Crenny in New York. Here's a look at what's on the slate today. We've got retail sales hitting the tape at 8:30 a.m. Eastern time. Then get ready for a slew of Fed speak. We've got Barkin, Collins, Logan, and Goolsbee all hitting the tape today. Will they join the Kashkari and Harker narrative? Housing earnings, KB Home will report after the market closes. So that's going to be the last one before you all rush off for your Juneteenth. Will any of you come back for Thursday and Friday? Individual names that are moving. Lennar extending its loss after the home builders forecast for deals in the third quarter missed expectations. Broadcom is on track for an 8th consecutive session of gains. That's the longest streak that it has had this year. And then TSMC, we've seen it bid up this morning. Frenzy growing in the USA. Citi raises its price target on that stock. We're up at 180. So that's state of play. Take a check on Bitcoin as well. It comes back a little bit. We're just off a 1 month low. Don't forget, in March, we were at that sort of zenith level of just under 74,000. You saw a little bit of money getting pulled out of the digital assets. $600 million was pulled from digital assets last week. That is the Bitcoin number. It is Juneteenth for you. Those of you who are calling it an early week, enjoy. For the rest of you who want to know a little bit more, tune in to Surveillance. That's up next. From the Brief team, have a lovely day off tomorrow.